When you look at silver, well, what's its prior highs? $50. Okay, well, doesn't look like it's accelerating yet. Give it a chance. Give it a chance. And we think highly likely those two peaks at 50 over the last 50 years will be gone within months.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for May 20th through May 27th, 2024 while supplies last. First, we feature pre-1933 XF $20 gold Liberty coins at just $25 over a 1-ounce spot. We also have backdated silver 1-ounce Philharmonics at $3.15 over spot. And finally, we have the hard-to-find silver half-ounce Canadian polar bears at the very competitive price of just $2.50 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance, and back with us today is our good friend Michael Oliver from Momentum Structural Analysis. Michael, thank you so much for joining us today.
Hi Elijah, good to be back.
Well, it's great to have you today, especially during this exciting time in the metals markets. We saw silver finally break above the $30 level last week, and now above the $32 level. We're seeing a bit of a pullback this morning, but I did want to get your take, and especially what the momentum is showing and some of the other ratios that people might not be looking at today. But just a general overview right now of what we've seen in both gold and silver over the last week, and I guess obviously the run up over the last couple months as well.
Yeah, no, I think we defined remember for the last 3.5 years, so gold has been in a range, really. It had one plunge that down to the 1600s in late 2022. But basically, if you chopped off that 4 or 6 weeks below that prior floor, gold was in a 15% range for 3.5 years. I mean, wow, that's extremely narrow, extremely dull, and it bored everybody to death. Okay. Now, but during that time, the miners and silver, which had a huge surge into the summer of 2020, vastly beating gold in that surge, went into a downward gradual staircase, and which wore everybody out. It's never going up. It's, what am I doing here, et cetera, et cetera. And crossing above 31.5 area on GDX, which is a very popular mining ETF, we had a major trend resumption buy signal. Now, right now on a dip, it's trading at 36. It was been up to 37 plus recently. So since the February low, it's really exploded in percent basis. Same time, silver has had a major surge, and we had what we call a major annual momentum trend resumption signal. Not that we were in a negative trend, we were in a boring trend, okay, but it resumed and said, I'm awake, okay. And that price was just above $25, was our trigger number there. And of course, we've exploded since, percent-wise. And gold is obviously the mama market, so you always have to watch gold, but gold is now underperforming its miners and silver. In fact, I sent you some charts that you might want to share that show the top chart shows silver in relationship to gold going back to 2020 when we had that big surge in silver relative to gold. Therefore, silver outperformed. And as you can see on that top chart, since then there's been a staircasing zigzag decline in that performance readings by silver, meaning it was underperforming over the last 3 years or so. Well, that ended. That's over. That has had a major breakout in the last month or so. And it says, okay, now silver is back to an outperform mode versus the mother metal. Same is true with the gold miners. And as you can see on that, there's a downtrend channel that it was stuck in for the last 3.5 years. And it has blown through it as of a month ago. So the indications we've got from our annual momentum trend resumption, measuring silver by itself, gold miners, et cetera, is thumbs up. And when we measure the spread relationship, they're thumbs up. Now, what's the importance of the spreads? If you go back and look at the acceleration phases, particularly like in 1979 through 1980, prior to the 1980 peak in gold and silver, silver accelerated versus gold. Okay? In other words, it did the same thing it just begun to do a month ago, which is to say, not only am I turning up, but I'm going to turn up more than gold. So we have technical reasons to believe, to argue, and we do argue and pound the table about it, that we are now in an acceleration phase in the monetary metals, and that the best place to be within that context is silver and the gold miners. And I think we're getting definite recognition from asset managers, too, that miners are a place to be. We've seen some big asset managers in the last several months position themselves in the mining sector, which is the most undervalued time in its history in terms of its relation to gold or in terms of its relation to the stock market. So it's a place to be.
Now, why is it that it seems like silver and the miners outperform as we really start to this last leg up in the bull market?
Well, it's just, they're undervalued to the mama metal. You know, they breathe, inhale, exhale. They both outperform and underperform, but they tend to outperform when the market's advancing solidly. And of course, for the last 3.5 years, gold's been not advancing. So therefore, it was time for the other guys to have a relapse. But now that we're net trend advancing again in all three categories, the two underdogs are now outperformers again. And this is the tradition. Well, like look at the summer of 2020 rally. Silver and price went from, we had a buy signal at $19.50. And several months later, it was what? $30. Huge percent move. Gold had a big move too, but it only went from like 1,450 to 2,000. So percent wise, far less than what silver did. So it's typical during strong phases in the monetary metals on the upside that silver will outperform gold. And now, you know, historically, if you look at an idiot price chart going back 50 years, let's say, monthly bar chart of gold. And you'll notice there was a high in 2011 at just below $2,000, $1,920. Then there was a high in 2020, in that summer rally, at $2,070 to $1,070. Okay, so $150 higher than it was 10 years prior. And then now we reached up to 2,450 recently. But we're emerging out above this gradually rising price pattern. But we're above both of those prior highs. Okay, look at copper. It's very interesting there. We know for the last couple of years that fundamental analysts in that arena have said, boy, we have a real tight supply problem coming up. And there's just not enough production of copper that when demand hits, we're going to have a problem. And now all of a sudden you're seeing the technicals of it. Actually, we get a buy signal some months ago, but it's now merged above its two prior highs. One was in 2011 when it hit $4.60. And then the other one was in 2022, and copper hit just above 5. And then recently we shot up to 5.30. Now it's also accelerating out above its prior gradual ascending highs. And we have momentum reasons to argue that. And when you look at silver, well, what's its prior highs? $50. Okay, well, doesn't look like it's accelerating yet. Give it a chance. Give it a chance. And we think highly likely those two peaks at 50 over the last 50 years will be gone within months.
Now, you've also mentioned in some of your recent reports that what is happening with copper and also what is happening in the metals markets, it's not your typical move. It's typically when you see dramatic moves, you know, there's pullbacks and it's kind of an arm wrestling match along the way. But this is not typical what we're seeing, and that we could just continue towards the upside. Can you expand on that?
Yeah, I think what most technicians have done, and it's incorrect, is to take the last 3 years of context, their inhale, exhale pattern of the market. I'm talking the monetary metals now, and assume that's normality. And if you stand back and look at a chart of gold or silver, especially, go back 50 years, get yourself a monthly bar chart that's logarithmic scaled, ratio scaled, and look at the last 3 years on that chart, and you'll see one of the dullest little clumps of ink in that 50-year period of silver. So the inhale and exhale that we've seen since 2020 has been exceptionally dormant. And therefore, all the normalities that you apply, let's say you're using the typical stuff on your screen like RSI or MACD or Bollinger Bands, et cetera, they've had a certain normality for the last 3 years where, oh, you get to certain levels on each. Oh, that's done. It's overdone. So you want to take profits. And sure enough, over the last 3 years, that's worked. But it's set people up for falsity. Because now we have a more dynamic situation where what your old norm overbought was, forget it. Overbought's going to be different now. Market's going to redefine what overbought is. And I don't think we've even reached there yet. I expect in the next year that silver goes ballistic, so does gold, in a way that is not just hundreds of dollars in gold or tens of dollars in silver, but much more over a much more compressed period of time. And I would expect maybe there'll be one good correction in that, let's say, the next year, where you get a horrible month. Okay. Not horrible 4 or 5 months, just a horrible month. Well, something to knock people off track. But we're not there yet. The kind of breaks we saw, what was it, 3 weeks ago in silver, where we dropped from a high at 29.80, somebody was selling just against 30, a brilliant technician. And we dropped a couple bucks. Most of that occurred in 3 days. And then you stalled the next week and then boom, blew out the high. Okay. So that was like a 3-day phenomenon, really. That's the kind of correction you're going to see going forward. So our expression of opinion to our subscribers was don't take profits. Now, there's a given level above gold that is about 3 to 5% above the high we saw this week so far. That if you get up into that zone, we'll pound the table. Do not take profits. That's been very popular for gold market analysts, quote unquote, to urge people to take profits in this rally. In fact, most of them have. And if you've done so, it's a good chance you missed what just happened. The last $200 in gold, the last $5 in silver. Don't get out of this market. We will try to define for our subscribers that one point we think will occur in the next, let's say, the next several quarters that might be worth exiting, especially if you're in call options, something very time sensitive. But if you're an investor in these markets, don't even think about taking profits. We're entering a phase now where the dynamics could be awesome. So, change your mentality. The last 3.5 years were deception.
So it sounds like within the next few months, you're expecting $50 silver and then the silver, I guess, to break out above even those levels?
Well, that will be considered a breakout. We don't. We look at momentum, and momentum is already, as far as we're concerned, broken out enough to say the sky's the limit now. The old ratios, if you go back and look over the last 50 years again, what is an ounce of silver in relation to an ounce of gold? And we measure differently than most. They use a ratio. We do it as a percent. So is silver expressed as a percentage of the price of gold, 1 ounce versus 1 ounce? And recently, silver got down to less than 1% of the price of gold. Right now, it's just above 1.3 in that chart I just showed. In fact, that chart's a little out of date. We're a little higher than we were on that chart. Over the last 50 years, if you go back and look at each year, what is the highest reading that silver had each year in relation to gold? And you'll find that of the last 50 years, 20 plus years have reached 2% or more of the price of gold. Well, just sit back for a minute, do your math. 2% of, let's say, gold's, even $2,500 gold, 2% would be $50 silver. Okay, so silver just getting up to its normal ratio that it's seen routinely over the last 50 years would be astounding for the net price expression of silver. Now, we don't think gold's going to peak at 2,500. We think that's going to be a launch zone that says we're going a lot higher, a lot faster. So anyway, so where silver might be in this over the next year in terms of net price could be awesome. I mean, it could be a couple $100, frankly. is our assessment. We're not going to predict that. We don't have a specific way to do that except to say, look at its normal ratio to gold over the last 50 years and see how many times it has frequently gotten up to 2% or even 2.5% of the price of gold. It's almost common. And right now we're only just above 1.3%.
It seems like before we saw the breakout in gold, and we saw a significant underperformance by the miners. The real question was, is gold going to come down or are the miners going to come up? And I guess kind of similar for silver is gold going to come down or silver going to go up? But it seems like that question has been answered. Is that?
No, usually those spreads don't work that way. In other words, we don't get silver gaining to gold because gold goes down more. That just doesn't happen. The spread is almost always 99% an expression of net price gain by silver versus gold. You go back through history and study the spread, and you'll see silver doesn't gain versus gold in the downside. It usually loses versus gold in the downside. So anyway, no, that's not to be expected, and sure enough, that's not what's happened.
And with respect to the other markets, I know you talked about copper, which has definitely broken out in the last couple of weeks here. You've said that this is kind of a change, I guess, in the commodity sector in general as well. What are we seeing in the commodity sector in general right now?
In October of 2020, MSA put out a report, said the commodity explosion's coming. We used the word commodity explosion. Back then, the Bloomberg Commodity Index was trading at 70. Its low had been in late 2020, about 60. Okay, it went from our buy signal about 70, went to 140 over the next 2 years. And by early 2022, it had gone from 70 to 140. So that was its first major resurgent bull leg. After years of pullback, its peak readings were in 2008. Bloomberg then was 230 something. And it dropped all the way down to 60. So it had a huge decline in commodity prices. That ended in October 2020 when we had a buy signal. But look at when that occurred. It wasn't coincident with gold. Gold had already gone to 2,000 in the summer of 2020, well before commodities even decided to turn up. This time it's different. Now we're getting a resurgence again in commodities after the pullback since early 2022. We had a correction back down to under 100 on Bloomberg. Right now it's 106, 107. We had a breakout a couple of months ago at 101. It says, okay, we're back in the upside. Next up leg is about to occur. And one of the leaders this time is copper. And I know everybody watches crude oil. And you see it on the financial TV channel. Don't watch it. Yeah, it's going to go up with commodities and natural gas as well. Those led that last bull leg in commodities from late 2020 to 2022. They were percentage leaders. Everything went up too, but they were leaders. This time around, copper looks like it's going to be a leader. And grains. Now, putting gasoline in your tank, is painful to the average American, especially middle class, lower middle class. But putting food on your table is also painful. And we had major breakout in wheat a month or two ago. It's already gone up about 80 cents a bushel. Soybeans and corn look like they're very close. Rice is also broken out. So basic foodstuffs of the world are now breaking out. So the Bloomberg is turned up again, but this time around the leadership is going to be in another painful arena, and that's food. Now, I know this is going to really mess up the Fed, and I'm all for it. They have two mandates. One is to, quote, keep inflation down. Of course, they misdefine it only as commodity inflation and such and related. They don't care when they inflate stock prices. That's okay. They're all for that. But when they inflate the price of corn, we don't want that corn farmer getting rich because that hurts us, So they try to suppress it. But I'll tell you what, the Bloomberg's going to overtake them. Commodities are going up despite their efforts. And in about 3 months, I'd say, after this upturn we've already seen in the Bloomberg, you're probably going to start to see the CPI and the producer price index also reflect that, in which case they're going to have a real pickle. Because if they still stick to their we're going to keep it tight policy, the data points on the other side are going to get sharply worse. We're already seeing the evidence. The unemployment is really not what it looks like. It's when you got to look under the surface. There's other data points. I mean, we've had companies like, Red Lobster just declared bankruptcy, okay? It's an average family's place to go have food. McDonald's has done a study, and they're having a real problem in their view, and they've expressed this publicly, with lower income people, consumption of their products. They can tell that the lower income clientele that they have is hurting. And they've stated this outright. And Target the other day just announced they're going to cut prices of 5,000 products because they sense it as well. So underneath the surface, things aren't real good on that other side of the Fed's mandate, the other mandate being unemployment and so forth. So I think they're going to be ripped apart in terms of the dynamics out there. One causes them to go one way, one the other. You can bet they're going to opt for softer policy. That's what they've always done. That's what the ECB is there for. That's what the Bank of Japan is there for. Print when it's necessary, and they will. They've already hinted at that in their recent report where they said they're going to cease their balance sheet reduction. They're going to slow it down. They're probably going to reverse it very soon. So gold knows this. That's why gold is advancing. It knows that monetary policy is going back to full throttle again.
Now, in one of your recent reports, you talked about the stock market and that this easing policy by the Fed will not necessarily be good for the stock market. Typically, I mean, in the last few years, we've seen easing being good for the stock market. But if you look back farther, it isn't always. And you're seeing that there might be a pullback or a significant downturn ahead.
They're easing of, that's like a Fed funds chart, for example. Go punch one up on the St. Louis Fed website, Fed funds chart. You'll see it. Go back to 1950s. We published it recently. We noted that when they eased the money supply and they took rates, for example, back in the early 1990s, 92, 93, 94, stock market was trying to advance then. It was stuck in a range, and they cut rates to the lowest level in 30 years at that time. And boom, the dot-com bubble followed. Did not occur when they cut rates. It occurred after they'd cut rates for a while, and then the boom came. And they raised rates during that rally. During like 1998, 99, they were raising rates, and yet the dot-com bubble continued. They first cut rates again in January of 2001. Not too long after the actual price high within the S&P had been in August of 2000. So it's 6 months after the actual high, not too far off the high, they began to cut rates. They cut rates for the next couple of years drastically. What happened to the stock market then? Collapsed all the way down. Cutting rates or not. Same thing happened again in 2001, 2, and 3. They cut rates drastically to the lowest level in 50 years. A couple years later, what happened? Boom, the real estate bubble and the stock market doubled in price after the rate cut. When they started cutting rates, and they raised rates during that rally, by the way, in 2007, in September, 1 month before the top tick, the Fed cut rates again. Started a rate cut policy. Again, market was making a new high in October of 2007. You could have shorted their rate cut and missed the high by 4 weeks, and it collapsed for the next couple of years. They cut rates all the way down, didn't do a bit of good. So if you go back and circle the point in 2001 and in September of 2007 on a price chart, and note that that's when Fed began the rate cut policy that was ongoing for several years. That's the best time to have shorted. Why? Because the Fed was panicked about something. They didn't want to admit it, but the real estate bubble they finally realized was real. Now, they cut rates again, they're going to be panicked about something. And there's plenty of stuff to be panicked about, and I think the stock market will soon reveal that. Our bet on the stock market is this. The rally we just saw that took out the March-April price high on the S&P marginally and on NASDAQ. You spin your wheels here for the rest of the month. Don't collapse, just muck around, spin your wheels, because we think we're at some resistance levels on momentum, not on price. And if you start down in June, by the time you get into July, we're going to hit certain trigger numbers that aren't far below the current market. I'll give you some specifics. S&P right now is trading above 5,300. In the month of July, you don't want to be trading around 5250. 1% below where we are now. If you do, we're going to start to break all kinds of stuff in terms of momentum. And I think at that point, we're going to start to see the stock market give it up. Well, for example, if you got out when we said get out, it would have been in January of 2022. We said be out of the market. Okay. Then we had a big collapse. Since then, we've gone back above that high after 2.5 years later, and marginally, single percent digits. So if you got out of the market then and bought a T-bill, you're beating the market, okay, or a CD. So it's a teaser. It's a protracted, major, wide top. And I think that the evidence of that will become more evident as we get into Q3, we say into July. And all you've got to do is to set that dynamite off is to muck around. No pausing here. If you pause, you're dead. And I think at that point, suddenly that component of the asset class categories that will impact the Fed and data points will begin to engage.
And that, it seems like, is what the precious metals are really signaling right now or noticing. So before we let you go, did you want to share with our viewers maybe some of the price points, or what should our viewers be looking at right now with respect to the precious metal markets?
There's, as I mentioned before, and I think this is probably the most important one. Forget the double top high in silver at $50. Taking it out, yeah, sure, you take it out at some point. That's not a technical signal of any validity. We had our signal at $25 recently. As far as we're concerned, the green light's on. Okay, gold miners at 31.5. They're at 37 or what. So looking at price charts, I think, is a lagged indicator. But in the case of gold, we have 3 very long-term momentum metrics that will indicate to us full acceleration mode, meaning verticality. And that price level, when you convert it to price, what does it take to engage those momentum triggers? It's like I said, we had the 2450 high recently. You get up into the low 2300s, like 2328 is our lowest number. I won't get real specific, but on up into the upper 2300s. Excuse me, not 2300s, 2500s. I'm sorry. We had a 2450 high. We get up into the low 2500 and upper 2500. We're going to have those triggers elected. And at that point, I expect to see gold start to go vertical in a way that will be, frankly, shocking to most. And that I think is a momentous, if I had to pin it down to one big zone of numbers, that would be it. And I think that won't occur in isolation. There's something else that's going to be going on in other markets. I would be watching the dollar at that point. The dollar right now is toying around with a major breakage level, just below its feet. In fact, we got down to the numbers last week, didn't close below them, traded down to them. So literally a half a point below where the dollar is right now is some very dangerous levels that will cause it to wake up and go down. It's been the dullest market in the last 2 years. It's been so dull, it's almost gone to sleep. And yet gold has gone up. Another market to watch that will be indicative, I think, of some asset class movement. Now, it won't last forever, but could be for several quarters, is a movement back into T-bonds, long side, meaning lower rates. And that will occur probably coincident with breakage of the stock market. Meaning, I think you've got to watch the T-bond market right now in terms of being inverse to the stock market. In 2022, when the market went down hard, bonds did too. So it wasn't a good alternative. But I think it's positioned itself now to where it could be for, let's say, several quarters. And that will be also indicative of what I'm talking about, all these dominoes starting to topple. So there's some big stuff to watch out there, and I think it could be fairly coincident.
All right. And if our viewers are interested in continuing to track this with you, they can go to olivermsa.com. I know they can see some sample reports there. Can you share with us that? Yeah,
and also simply find my picture under the who or whatever they have us there. My email is, send me an email, I'll send you sample reports for you to look at. And we cover all 4 major asset categories. I think it's important to do so because they're very much tectonic plates that are bumping into each other. So what one does, another will impact, et cetera.
Fantastic. Michael, any last thoughts before we let you go?
This year is going to be one of the most dramatic market years you've ever seen between now and the end of the year. A lot of it occurring before the election.
should be very exciting. It's already been a very exciting year in the market. So we anticipate more excitement here, and we'll definitely have you back on soon. Thank you so much, Michael, and God bless.
Thanks, Elijah.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for May 20th through May 27th, 2024 while supplies last. First, we feature pre-1933 XF $20 gold Liberty coins at just $25 over a 1-ounce spot. We also have backdated silver 1-ounce Philharmonics at $3.15 over spot. And finally, we have the hard-to-find silver half-ounce Canadian polar bears at the very competitive price of just $2.50 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.